We're really excited to have everyone here today. My name is Wesley Williams. I'm a technical accounting manager here at LeaseQuery. A little bit about myself, a little background. I previously was at KPMG for a few years in external audit. So I've had the joy of working with these lease accounting standards and actually had the unique opportunity to actually audit LeaseQuery as a tool for one of my clients. So a lot of experience there. So really excited to walk through today, giving you an idea of how we're going to be calculating that implicit rate under GASB 87. I'm also joined by Danny Martinez from Cherry Bekaert. We're excited to have him with us as well. We're excited to be here with Cherry Bekaert, but I'll let Danny go ahead and introduce himself.
Hello, everyone. My name is Danny Martinez with Cherry Bekaert. And while I'm relatively new to the firm, not new to public accounting or GASB 87, at Cherry Bekaert, I will be serving as the government and public sector accounting advisory lead. I spent quite a bit of time, given the GASB 95 delay in helping organizations with the implementation of GASB 87. So I'm really looking forward to serving in that role here at Cherry Bekaert and sharing some input with you all today.
Awesome. Thanks so much, Danny. So before we get into the presentation, we want to talk a little bit about what our partnership is, right? As you see, LeaseQuery plus Cherry Bekaert, right? We're here together and excited to be here. But again, I want to talk a little bit about our partnership together and really why we have that partnership. But first, just to give you an idea about who LeaseQuery is. So we were founded in 2011 by George Aziz. He was a lease accounting expert for his company and saw this need in the marketplace, right, of technical accounting software to help with this lease accounting, and so made the jump in, started the company, and really based it from an accountant's perspective, right. Now we have up over 3,000 customers, excuse me, in 87 countries, and really some of the things we're more proud of here are at the bottom, right. We're ranked number 29 on the Inc. 5000 list of nation's fastest growing companies. And we consistently get really great reviews from our customers in third-party review sites. And then we have a 99% retention rate. So really work hard to make our customers happy. But that's a little bit, again, of just who LeaseQuery is as a company. Now, why did Cherry Bekaert and LeaseQuery partner? Really, we want to, when we met and talked through this partnership, we really wanted to offer a total solution for asset management, right? We wanted to be able to give Cherry Bekaert's clients and prospects just the opportunity to have that full solution for the asset management. We wanted to help automate processes, to capture journal entries for companies with transitioning assets, and then really we wanted to align client needs, and that's probably the biggest part there, right? Cherry Bekaert has seen this need in the marketplace for the lease accounting. It's a very technical topic. That's why everyone's here today, right? It's a complex standard with a lot of nuances, a lot of difficulties in there, and so we found that happy medium, right, where we can offer a solution to help meet those needs and create efficiencies and make it easier for Cherry Bekaert's clients as well. And so again, we're very excited to be here today together. Now, to give you an idea about what we're actually going to talk about today, we'll walk through the agenda here. So we're going to talk about and give you a little bit of an introduction to GASB 87, make sure everyone has that good basis of what GASB 87 is and how it's affecting your portfolio before we get into the actual, the nitty-gritty of it as you were. Then we'll talk a little bit about an overview of discount rates, right? That's obviously a big change in the standards. Now all leases have to identify discount rate and figure that out, and it's caused lots of headaches, lots of problems, and again, probably why you're here today. So we'll get you covered there. And then we're going to talk a little bit about the implicit rate, define it, and then we'll actually walk through an example of how to calculate the implicit rate. So we'll walk through a detailed example there. So I'm going to pass it off to Danny here. He's going to walk us through the introduction to GASB 87 here. So I'll go ahead and pass it off to you, Danny.
Thank you, Wesley, and just want to reiterate, we really value the partnership with LeaseQuery to be able to provide, like you said, that total solution. So we're going to start off with the introduction to GASB 87. So you've likely went through numerous introductions to 87 already, right? We've been talking about this for some years. We had the delay with GASB 95. So this may be the part of the training where you're thinking, well, I can tune it out for the next 10 minutes or so because I've heard that. But what I'm hoping is that as I work through this introduction, maybe you'll hear something that, oh, I hadn't really heard it, presented that way. Or, now you're actually in the period of implementation. So some of these things that you might have heard that were maybe a little bit more abstract, okay, I get it. Now as you're working through your leasing population, you might say, oh, okay, I see how that applies to, to X lease, or in this scenario that we have, that's how I would think about it. So hopefully here, while it may be information you have heard before, I'm hoping to provide it in a way that where you still get some nuggets of wisdom there. So let's go ahead and start with this legacy accounting standards. So where are we now, or where were we before the 6/30/22 year ends? So the guidance that we had that governed legacy lease accounting included these three places. We had statement 62, which of course is the stuff that was brought over from FASB that didn't contradict with GASB statements. We had statement 13, and we had the National Council of Government Accountants number 5. And I just want to point out that last one, National Council of Governmental Accounting, that came out in 1982. And so I feel pretty comfortable. I've met with Wes. I feel pretty comfortable speaking with him that neither of us could even spell NGCA back in 1982, much less understand how it applied to lease accounting. So all that to say, it was time for a refresh. So let's look at where we are now with 87. And so the way that this worked is, we had International Standards Board looking at it. We also had FASB looking at leases, and so GASB also decided, hey, now would be a great time to update our approach. And so where we landed is this single model approach. So what does that mean? That means we are no longer talking about operating or capital leases, right? We just have leases, and what GASB came down to and determined is that leases are financing. So the lease type here, we have a finance lease, so that would be all in scope leases, and we're going to dig into what we mean by all in scope leases here in a minute. How are you going to apply this to your leases? So we're doing a modified retrospective approach. What that means is the facts and circumstances as of the earliest period presented. So if you think about it, you have a single year financial statement. Let's say it's a June 30, 22 financial statement. It'd be facts and circumstances as of July 1, 21. If you have comparative financial statements, you're going to be going back to that earliest year presented, and in that case, it would be July 1 of 2020. Of course, in there, GASB does provide that statement that says, if practicable. So what does that mean? That doesn't mean, oh, it's hard. It means you literally do not have the records available to be able to get back to that prior comparative year. So that would be a very high bar and difficult thing to assess. And again, as I mentioned in our examples, the effective date is 6/15/21, so periods beginning after that date. So right now we have the 6/30s about a month into the year in which they are going to be audited, right? They're 6/30/2022, so hopefully they're very close to, and if not finished. We have the 9/30/22s waiting in the wings, and lastly, we have the calendar year end people who are hopefully working through this, but also kind of sitting back and hoping and to learn from those adoption periods of June and September. So the definition. So this is one of my favorite things to do when I'm meeting with a client and I'm talking about implementation is let's really break down that definition and each of the pieces within that definition, and let's see what they actually mean and how we apply it to our population. If you all have ever sat in on the GASB's meetings, which I did when I was on the AICPA's Technical Issues Committee, or you can even watch them on YouTube. You'd be shocked to see that there's not too many viewers on those live streams, but they are available. But when you're in those meetings, you see how much time and effort goes into things like a definition, right? If we're going to be defining a term, we are going to pore over each word and make sure that we feel very comfortable with how we are defining something within the guidance. So here you can see the definition of a lease is a lease is defined as a contract that conveys control of the right to use another entity's non-financial asset as specified in the contract for a period of time in an exchange or an exchange-like transaction. So let's go ahead and break that apart here in the next few slides. So the first thing that we're going to talk about is control. So what are we saying whenever we say conveys control of the right to use an asset? Well, we're really talking about two things. We're talking about one, the right to obtain the present service capacity for use of the underlying asset. So can I drive that car? Can I occupy that building as it's specified under the contract? And then lastly, do I have the right to determine the nature and manner of use of the underlying asset? Am I allowed to drive it for whatever I want, or for just to use the building in any manner that I see fit, and where someone else can't just come in and completely change or dictate what you do? So that's really what we're looking at in terms of control. It is a complex topic, right? There really is a spectrum of control. And to give you all a little tip here, if you're not aware of the GASB implementation guides, we have, there's 2019-3, 2020-1, and 2021-1 that are implementation guides that you can find that has about 100 combined Q&As, and control really is one of the topics that they dig into. For example, in the 2020 implementation guide, there's a question that says, we lease this building, but they told us we can only use it for a restaurant. Does that mean that we can still dictate the nature and manner of use? And the response to that is yes, because it's as specified in the contract. So in the contract, you're saying you can use it for a restaurant. So as long as you can dictate it within those parameters, you have control. Next slide. We're talking about a non-financial asset. So the reason that we say non-financial asset, it's going to scope out some securities lending transactions that would otherwise maybe meet the definition of a lease. So things that you're thinking about, most common ones: land, building, vehicles, equipment. Some other ones that you may want to think about: cell phone tower attachments, medical devices, airport concession operations, rental car shuttles. If you are using a thing that is tangible for more than a year, then you want to be looking at that and evaluating it and determining if it is a lease or not. Next slide talks about for a period of time. So the time frame of use must be explicitly stated. So this is scoping out those leases that are indefinite. We're thinking about it, you're putting it on the books, right? You need a term. You need to know how many years you're going to spread that liability over, and if it's indefinite, you're kind of stuck as far as what is the time frame of the lease. So in there, you're looking for a period of time and to be able to identify what the lease term is under the contract. Next slide is an exchange or exchange-like transaction. So are you getting equal or near equal value in return? So as you know, we have GASB 33 that covers non-exchange transactions. So some examples of non-exchange transactions in the government world may be donations, grants, or governments enter into agreements or contracts sometimes for purposes other than generating a profit. You could think about those $1 leases. If you provide these services to my constituents, I will then lease this building to you for $1, right? So that is not an exchange-like transaction. Just like we talked about a spectrum with control, you also have a spectrum when you're talking about is it an exchange transaction. I can give you a very easy example saying, hey, we're leasing a building at market rate. Okay, that's an exchange-like transaction. I'm leasing a building for $1. Okay, that's not an exchange-like transaction, so that's scoped out. But there are some circumstances in between where you will need to apply a little bit of judgment. I can give you an example from one of the large municipalities that I'm helping to implement. And what they did is they have fixed the rental payment that certain vendors are paying to them in an area of the city where they're wanting economic development. So these entities are paying rental rates, say they entered into the agreement in 2000, so they're paying the year 2000 rental rates in 2020, and so maybe that's 50% of market value, 30% of market value. So it lands somewhere in between the $1 and the market rate. So you'll really want to think about and put into policy what that means when you enter into an exchange or exchange-like transaction. There are some things that are scoped out, and you can see the list here. You also find them in GASB 87. Intangible assets, so ability to drill for oil and gas, biological assets, inventory, service concession arrangements were handled under GASB 60, which are now moving over to GASB 94. Supply contracts. The next two I'll touch on here in the next slide, but just real quick on the biological assets, those you can think of as like zoo animals, for example. Some municipalities lease their zoos, and we've been doing these presentations for so long on 87 that we're kind of running out of titles. Last year at a regional conference, one of mine was, I think it was Lions and Tigers and Leases, oh my, or something like some way to get people to still want to learn about 87, but that's an example of something that is scoped out. So let's touch on these last two in the next slide. So title transfer to lessee.
And before we go on, Danny, I just have to say that is an amazing title. If everyone did not laugh at that, that is a problem.
That one, and I had one called Mona Lisa, create your lease masterpiece, but I spelled lease like it's bad. It's embarrassing.
I love it. I love it. I'm sorry to interrupt. Just love it.
No worries. No worries. So title transfer to lessee. So this is effectively seen as a finance purchase rather than a lease agreement. So what does that mean? I am leasing a thing from you for 5 years. I can't get out of that contract in any way, and at the end of the 5 years, it's mine. Well, that's not necessarily a lease, right? You're financing the purchase of that, say, vehicle in that case. So in that case, you would just treat it as debt. However, there are other circumstances that you're seeing that don't have that same treatment. So say you have a bargain purchase option. You have a lease, and at the end of it, you can buy it for $25. Well, you're gonna do it, right? But until you exercise that option, is still treated as a lease. Another example is, say you have a lease agreement, same thing, 5 years, but you have a termination clause in there, meaning after 3 years I can bail, and even though it doesn't make sense that I'm going to, after 3 years I can leave, and you have to take that vehicle back. Regardless of whether or not it's likely that you're going to do that, the presence of that option means that it is still a lease and not a finance purchase. So just some nuances in there that you want to think about. Last thing before I get to our polling question and kind of move on to discount rates is this idea of a short-term lease. So the short-term lease exception is for leases that have a maximum possible period of 12 months or less. So this is considering all of your extensions that may be present within the lease. So under the contract, if the maximum amount the contract will be for is 12 months or less, you have this short-term lease exception. Let me give you two examples. So the first example, say you have a lease for 12 months, but you can renew it. You can renew it by yourself, click a button, renew it for another year. that is not a short-term lease because you have that in there where you can extend. Thinking about a similar example, you have a lease for 1 year, and at the end of the year, you can go back with the lessor and say, I want to renew this for another year. You've been doing it for 40 years. In that instance, that's still a short-term lease. Well, why? Because that instance that you have to go back to the table and sign another contract causes it to be a new contract. So that means your initial contract, maximum possible lease term, was that initial 12 months. Hopefully that little introduction gave you at least a little bit of guidance. And so now I'll go ahead and turn it over to our first polling question. So how would you describe your understanding of GASB 87? Make sure you get your clicks in for CPE.
And just to make sure everyone's aware, as Kylie mentioned at the beginning, feel free to throw questions in the chat. During these polling questions, we'll have a little bit of a break here, just for about a minute or so. So if there are any questions outstanding, we're happy to address those here. If you put them in the chat and we don't end up getting to them in the polling question, we will follow up after with a response or so. We will make sure we get your questions answered. But again, like Danny mentioned as well, please make sure you're responding to these polls. We want to make sure we can give you that CPE credit, but you will need to respond to 3 of the 4. Okay, well, thank you everyone for getting that in, and we'll let Danny continue with discount rates here.
Great. So to the topic at hand, right? We laid the groundwork, did a little bit of level setting, but now let's get to the topic at hand, and that is discount rates. So what we're going to be covering for the second half of the presentation today is that implicit interest rate. But let's touch on the 3 different options that you have within the standard, just to help you think about it. So the discount rate that you're going to be using, you have 3 options. First, is there an interest rate stated within the lease, right? Do I have a rate that I'm financing at within the lease? And 95% of the time, as you're finding, I'm sure the answer is no, right? That's probably why most of you are here today. Second, as GASB stated in the basis for conclusion, is that it's preferable to use the interest rate implicit in the lease, which is what we're going to be going over today. Lastly, GASB gives you that third option of if neither of those first 2 are readily determinable, then the estimated incremental borrowing rate is an acceptable alternative. And what we're seeing in practice is sometimes people are wanting to jump to that third incremental borrowing rate without really thinking through if getting the implicit interest rate is readily determinable. And the answer may be no. I can't get it, but just want to make sure that you're thinking through the guidance as far as those first 2 approaches are preferable, because you'll want to be able to explain to your auditor what you did to at least think about this implicit interest rate that Wesley's going to be going over. So let's take a look at why a discount rate. So majority of our leases are going to be on the statement of net position, and so you're paying future dollars for the right to use these assets, or you're being paid future dollars for those lease receivables that you had. So we're trying to get a better, more accurate representation of what that would mean as far as a present value of your obligations or of your receivables. So the discount rate is the way that we do it, right? We're going to be calculating that net present value of the payments and the payables. So I'm going to be paying $10,000 a month for 30 years. What does that mean if I were to enter into a transaction like that? What would be, right, leases are financing, what would be the financing arrangement for that? And how much of that $10,000 that I'm paying a month over 30 years would have been principal and interest? So that's kind of what we're looking at and thinking. I did mention, and it's not the topic of the rest of this presentation, but that third option of the incremental borrowing rate, here's what I was talking about. So if the interest rate cannot be readily determined by the lessee, right, you're going through and you're making that
assessment first of is this readily determined or not, then an estimate of the interest rate that would be charged for borrowing the lease payment should be used. This incremental borrowing rate is another hot topic. That could be another hour just on this. In fact, later on today with one of our leasing clients, I'm going to be meeting with them and kind of discussing ways to think about this incremental borrowing rate. But I just wanted to let you all know that we are seeing entities struggle and have issues with this incremental borrowing rate and how to think about it. And this is one of those areas where please reach out to myself or your Cherry Bekaert advisor, and we'd be happy to kind of guide you through and talk you through that determination. But hopefully we're able to give you some guidance first here in the next half an hour on how to think about the interest rate implicit in the lease and where you can capture those. So with that, thank you so much for your time, and I'm going to turn it over to Wesley to help you guide you through that determination.
Awesome. Thanks so much, Danny. And really appreciate you walking through to give everyone, that basis, and then also to give an idea about some of those discount rates. And so what we'll do now is just talk a little bit about how to calculate the interest rate, that implicit interest rate, what goes into that, and then we'll actually walk through a detailed example here as well. So we'll start with just understanding what is the implicit rate. Now, as you saw in Danny's slide just a second ago with the incremental borrowing rate, that is defined in GASB 87 specifically, but implicit rate is not specifically defined in the standard, but it does reference another standard. So reference statement 62 for an explanation of what that implicit rate truly is. And so we'll walk through this real quickly here, but what that implicit rate is really is the discount rate that, when applied to these next 2 points, will identify what the actual implicit rate is. So first of all, we'll look at the discount rate applied to the minimum lease payments, right? Excluding the portion of payments that represent executory cost to be paid by the lessor. So a lot of times, right, that minimum lease payments is going to be more defined as that base rent, right? So we're going to be focused on what those minimum payments that we have to the lessor are. So those are going to be those future cash payments, together with any gain, right? If we have any gain expected on those through additional avenues there. And then also we'll look at any unguaranteed residual value, right, accruing to the benefit of the lessor. So if there is that residual value, that's going to affect our actual calculation of what the implicit rate is defined in that lease, because that's going to reduce that overall value that we'll expect, because we'll have that residual value. And so this is that causes the aggregate present value at the beginning of the lease term to be equal to the fair value of the lease property to the lessor at the inception of the lease. So walk back a little bit. We're going to take the present value, right, at the beginning of that lease term, and we want that to equal the fair value. Again, at the inception of the lease. So we're going to go back to the inception of the lease and identify that implicit rate, right? If we're doing this rate as of transition, right, that's not when we're going to be calculating that. We want to calculate it as of the inception of the lease. And then you'll take off any investment tax credits retained by and expected by the lessor. So a lot of words here to explain what this is. But really, right, we're going to focus on those minimum lease payments, right, that base rent. Take out any additional executory cost, subtract, right, that unguaranteed residual value, and apply that there. And so we'll look at what that looks like here again in detail going forward. But that gives you an idea about just how it's stated in the standard of what the implicit rate is. So that rate that causes, right, the present value again, plus the present value of the unguaranteed residual value, add those together, and it should equal the fair value of the asset. Again, take out any of those tax credits, plus any initial direct cost from the lessor. So that's how we define that implicit rate, as a very simple idea here, right? Is the present value plus the unguaranteed residual value should equal that fair value plus any initial direct cost. So hopefully that gives you a good representation, I guess, always easier to see in a flow chart in this way of how we'll define what that implicit rate is. So we wanted to give that just quick rundown, quick basis before we jump into the actual detailed explanation here. But before we do that as well, we'll take another quick pause here for our second polling question. So we just want to understand, what stage of the lease implementation process is your organization in? We'll open this polling up. Like Danny mentioned, we have, the 630s that hopefully should be in the audit phase, all right, or I guess preparing the financial phase and getting ready. So should hopefully be there close to, if not ready, for that transition. Obviously, the 930s and the year-end, calendar year-end companies have a little bit of a gap there, but hopefully you're in those later stages. But if not, we're here ready to get you a good understanding of those rates so that you can start calculating that and getting your amortization tables rolling. But again, we'll leave this poll open up here for a minute.
As we leave the poll up, I can answer one of the audience questions. It was about the short-term lease. So if you have a one-year lease agreement and the agreement does not talk about renewal, but you have to go to the vendor for renewal, would that be a short-term lease? So what you're looking at there is in the contract, after that year, what happens? Is there another contract that needs to be entered into? And do both parties have to agree? Then that would point it to being a short-term lease. Again, with all these answers, without seeing the exact lease agreement, I don't want to completely lead you in a specific direction, but that's the accounting the idea behind it. And if you do have short-term leases, what do you do with them? Well, then you just recognize either the inflow or the outflow of resources in the period which it incurs. And so outflows and inflows of resources in government world means the money coming in, money going, and the payments going.
Awesome. Thanks so much, everyone, for getting your responses in there. And we'll go ahead and continue now in the presentation. So what we want to do now is we want to talk about and walk through, an example of how to actually calculate the implicit rate. And so in this example, we'll use some background information. So we'll use some standard information here to give you an idea of how we're going to calculate this. And so what we're expecting on this lease, and that we'll use throughout this example, is that we have a lease that has charges of $4,000 annually, paid directly to the lessor at the start of each year. So we have those minimum payments, right? That base rent, whatever you want to call it, of $4,000 annually, paid at the beginning of the year. That lease starts in January 1, 2020. And so that would be our first $4,000 payment. And then it's going to be a 5-year lease term. So we're expecting, and we, based off our analysis, the fair value of the asset at lease commencement is $15,000. And the lessor expects the fair value of the asset at the end of the lease term will be $1,000. So that's that unguaranteed or expected residual value, right? So the lessor is expecting that $1,000. So if you remember earlier how we talked about, how that's going to come into play here, we'll show you in the example here. And then also too, with this, the lessor, incurs an initial direct cost of $2,000. So remember all this information, $4,000 annually for 5 years, starting on 1/1/2020. We're expecting the fair value to be $15,000, an unguaranteed residual value of $1,000, and initial direct cost of $2,000. So how do we go about calculating this implicit rate? Well, we'll set up a schedule here, right? Get your Excel out and ready to go. We'll set up periods, right? Our period's gonna be our first column here. We'll break it out into our periods. So we have a 5-year period. We're gonna need to identify what the fair value is, any residual value, any initial direct cost, any prepayments, and then what those net cash flows are. So we're gonna have to identify these, and we'll walk through what these are first. So we'll list out our 5 payments here, our 5 periods here, excuse me. Now we have our fair value, right? Our fair value we stated is $15,000. So we'll set that $15,000 payment up here. Then we'll need to set up our residual value. So we know that the lessor is expecting that asset at the end of the lease to have a residual value of $1,000. So we'll input that here. Now, we also talked about that the lessor had $2,000 worth of initial direct cost. Now, remember from the picture we looked at earlier, that present value will need to equal the fair value plus any initial direct cost. So we have that $2,000 of initial direct cost here that we've inputted. Next, we talk about our payments in advance. We're paying in advance $4,000 at the beginning of each year for 5 years, right? So we set those $4,000 payments up here. Then we calculate our net cash flows. So in the first year, we have that fair value, so negative $15,000 minus the $2,000 for initial direct cost, and then our prepayment, so we get that $13,000. And then each year, we have those $4,000 payments, landing on a unguaranteed residual value of $1,000, which gets us down to that total here. So we set up this table here, right? We set up those balances that we know based off of the background information that we've obtained. Now we need to start actually calculating that rate. So we'll take all of our net cash flows, right, which includes the fair value, the initial direct cost, those prepayments, and that $1,000 residual value. Then we'll be able to see that implicit rate. So, right, so I'm gonna back up one more time. We're gonna use that IRR function, right, for the net cash flows, right? That's why we got Excel, that our trusty tool here, right? It's gonna help us calculate that. So, but we have to be able to have all that information laid out first, so we can, but then use that IRR function, and we'll get that implicit rate here. So, you know, really the most important part here when we're thinking about how we walk through this calculation is understanding and identifying all the key pieces within our lease, right? And you know, I think sometimes a difficult piece to identify is that fair value, right? You know, there's multiple ways we can go about doing that. It depends on what type of asset you're thinking about. But you'll need to identify that fair value in order to be able to calculate this implicit rate, right? Because we need that present value in order to equal that fair value. So we have to understand that fair value there. And then understand, again, too, if we have any initial direct costs, if we have any, you know, of those expected or unguaranteed residual values in order to calculate that here. And then just lay it out here, right? Lay that out in a schedule so that we know what our balances are, know what our cash flows are. And then again, looking back here, that IRR function. That's what's gonna help us calculate that implicit rate based off of our net cash flows and get us here to that 11%. So, you know, hopefully walking through that quickly, you know, as an example, gives us a good idea of actually how we're going to calculate that. Now, you know, there's different nuances that can come in. And so I think it's important to have this good base understanding of this calculation so that you know if there are any additional pieces that you have to consider, you know how to handle it, right? You know whether they're going to be included or going to exclude them as well. So again, hopefully walking through that here as an example and showing you right here in the table gives you a good idea. But what we'll do here is pause again for another quick polling question, and then we want to talk about how we validate the calculation. So we'll open up another polling question here, and again talk about how do you currently plan to, or how did you comply with GASB 87? So for those 630, you know, we're interested on how did you comply with GASB 87, and for those upcoming year ends, how are you planning to comply with GASB 87?
And looking back at the questions as we work through this, one of them was just the thing that you touched on there at the end about how do you determine that fair value, right? And that it really is one of the things that's hard and goes back to that idea of readily determinable. First, for things that had been purchased maybe more relatively recently, maybe you can find some stuff out there as far as what that would be. What if we were entering into an agreement for this thing? How much would I be paying for it? So you're just searching for market data for similar types of assets, similar timeframes, and seeing if you can come up with what that would be to then plug it into the transaction.
Yeah, I know in practice and talking to a lot of our clients and prospects, and that's always a common question. You know, well, how do I figure that out? And you know, like you said, just you have to go and use those market indicators, right, to help identify that true fair value, so you can calculate that implicit rate.
And even if you can't do it for all of your leases now at implementation, right? Then how about, you know, for the ones you're entering into in fiscal 22 or fiscal 23, where you don't have a stated rate, you know, thinking about that as you enter into these new agreements, of being able to identify what that fair value is, will be helpful.
Yeah.
Awesome. We'll close this third poll down in 3, 2, 1.
Okay. Again, thank you so much for getting your answers in there. We're gonna have one more polling question at the end, so if you've missed one so far, don't worry. You can still get that credit just by making sure we stay around for that last polling question here. But we'll go ahead and move on throughout the presentation, and we'll start here with validating the calculation. So let's look back, right? We looked at this earlier and we walked through a little bit of the example. But remember, you got to take that present value of the lease payments. So that's what we did, right? We found those cash flows, the net cash flows, to understand what this present value are. You take that present value of the unguaranteed residual value, right? In this example, it was stated for us. The lessor expects that $1,000 to be the value, right, when you return that asset to the lessor. So I know there was a question about that earlier. You know, what is that present value of the unguaranteed residual value, right? In our example, it was that $1,000. But again, that's something that was stated in the lease, right? Not every lease is going to have an unguaranteed residual value or an expected residual value, but typically we see, right, that's stated in the lease of what they're expecting to get that back at. And those balances, right, are going to equal the fair value of the asset minus those tax credits, and then those initial direct costs, right? So we had that $15,000 of fair value and the $2,000 of initial direct cost, right, is going to equal together with those lease payments in that unguaranteed residual value. So we need to find that calculation here. So use this as an overall guide here, right, especially as we were thinking through that example here. But also what we want to talk about here too, and give you an idea here, is that we also have a present value calculation tool that you can utilize, LeaseQuery, right? These slide decks are going to be attached to this presentation, so you should be able to download them from the GoToWebinar panel on the right side of your screen. But then you'll have a link here, right, in the presentation. So we have a great tool to where you can enter that in and not have to create your own schedule or your own your own Excel schedule. You just enter those periods, what period is, right, when those payments are at the beginning, what the actual cash payments are, and it'll create that present value for you. And then it'll give you that annual rate. So please use that tool. It's a free tool, but we do offer that for you. And so we would love for you to benefit from that if you are going through and calculating that implicit rate here. Excuse me. Also too, you'll be able to calculate, again, that expected residual value, right? You'll input what that present value is to identify that, and so you can use that as part of your calculation once you do identify, that annual rate here. So if we plug our numbers here, based off the present value, right, from the example we took, we had that $15,000 fair value of the actual asset, the $2,000 of the deferred lessor initial direct cost equals $17,000. That present value of the lease payments. So if I go back a couple here, right, that present value of the lease payments gets us to $16,407, and the present value of that actual residual value guarantee, $593, right? Add those together, and we got our $17,000. So the present value of the lease payments plus the present value of the residual value equals that fair value plus the initial direct cost here. So part of that calculation here, and I see also that tool to the present value calculator is in the chat. So if you want to access that as well, it's right in the chat here for you now. Or just go to leasequery.com and you'll find that under the resources tab. So we validated that calculation, right? We went through and actually did that present value to identify that truly, yes, the present value does equal the fair value here. Now, again, we have those implicit rate tools and those things to help you out here. Not only, I guess I talked about the fair value earlier, the fair value tool, present value, excuse me, I'm all over the board with values here. But we have the present value tool we talked about, but we also do have that implicit tool as well. So if you'd like to use that as well, again, right on LeaseQuery's homepage under the resources tab, you can utilize this here to help calculate that. Really, like we talked about, the main thing that you're going to want to focus on is identifying that fair value. I think that's something that it tends to be the most difficult part of this. And so I'd say focus your time early on identifying fair values there. If not, understanding that from the lessor as well.
All right. Well, thank you. I'll go ahead and jump in here for the wrap up. Just want to say thank you again to Wesley and LeaseQuery for joining us on this presentation, but also for the larger partnership to be able to provide everything that our clients need as far as GASB 87 implementation. And here's a recap of what we went over today. We gave you that introduction. We talked about the discount rate options under 87. Dug into the implicit rate, how to most importantly, how to calculate and validate it using tools that have already been made for you, rather than having to create your own tools. So I guess to close, before we open it up we have the last polling question, but before we open it up to any questions, go to the next slide. I just want to say, if you haven't completed that implementation journey, please don't go it alone. This 1 hour was just a fork in the road within the standard of 87. And so whether you have 20 leases or 2,000 leases, there are many nuances within the standard where having the technical guidance, having the software capabilities will really help you out and help your organization out in providing accurate and complete financial numbers, and in succeeding in your first audit under the implementation of 87. So if you all are interested, even if you're not ready yet, maybe you're at 1231, just put in a little plug for LeaseQuery here and say you should go to this link, and schedule a free demo, see in more detail what they provide, and get that offer as well. For the Cherry Bekaert side, this is in my role as the accounting advisory lead, this is one of the things that I spend a lot of time on. So if you have any questions on the technical side related to the standard, please reach out to your Cherry Bekaert advisor, or you can shoot me an email as well, and I'd be happy to talk through anything with you all. So let's go ahead and get to that final polling question.
Awesome. And it's an easy question here, right? Would you like to see a demo of LeaseQuery? We'd love to spend a time, we'll set aside an hour for you where we'll walk through in depth your portfolio. If you have specific questions, that's where we can answer them. We'll show you how LeaseQuery as a tool can create some, lots of efficiencies throughout your organization, and also to really just take the burden off of you to comply with the standard, right? Really just automates that compliance for you. So again, we'd love the opportunity. My team, I would be one of those that would walk you through, or someone else from my team, walk you through, answer in-depth questions, and then again, show you the tool and what we have to offer. So again, we'll leave this open for a minute or so here. And again, make sure you get your responses in. We definitely want to make sure this time was well spent, not only for the information, but also again to get your CPE credit.
And if last plug on the Cherry Bekaert side, if you enjoyed this content, we're really trying to continue to provide quality content to our clients. We'll be doing a podcast probably within the month. I'll be sitting down with Scott Anderson, who just returned from his GASB fellowship, and so we'll be digging into current and future pronouncements, how it's impacting the industry, things that he saw from the inside at GASB. So please be looking out for that podcast as well. If I'm not connected with you on LinkedIn, I'm pretty active on there, sharing some good information. Just look up Danny Martinez CPA, and definitely be following our Cherry Bekaert page as well.
Awesome. Well, again, we'll leave that poll open just for a few more seconds here. Make sure you get your responses in.
Okay, and we'll close this last poll down in 3, 2, 1.
Awesome. And we'll just wrap up real quickly here. We just want to thank you so much for your time, both for myself and Danny. We really appreciate it. Hopefully you learned a little something. Hopefully you got some CPE credit, and then we'd love to, talk to you in the future as well, whether it's through a demo, whether it's through reaching out to, Danny and his team over there at Cherry Bekaert. They're a great resource for you. So please feel free to reach out to either of us. We'd be happy to help, be happy to be a resource for you. But this is the conclusion of our presentation today. So we wish you well and have a great rest of the day.
Good luck, everyone.